Today on Becoming an Intelligent Investor, we are joined by someone who has dedicated his career to helping South Africans understand money in a clear, practical, and empowering way. Talani Ndimande is a wealth manager with nearly a decade of experience supporting professionals, entrepreneurs, and families on their journey from earning an income to building long-term financial securities. In this conversation, we are diving into his journey academically and professionally and unpacking what it truly means to become an intelligent investor. Lani will help us make sense of the money mistakes we all make and the opportunities we often overlook. Delani, I would like to take this moment to say welcome to In Conversation. How are you?
Well, thanks, and how are you, Tsepiso, and thank you for having me.
Awesome. I want us to start at the beginning. Can you tell me where did your interest in finance and investing start?
My interest in finance developed from a young age, and I mean, then that's when I just basically discovered that there's something called the stock market and the financial market in totality. And then from there, that's where my curiosity started developing. And I always had this idea that I'm just going to be an investor, grow my own funds, and also help people grow that. And so that's when now I was just always having this interest of saying that, look, there's no turning back for me. It's either I'm into investments or nothing. So yeah, I think in summary, that's basically how it all began. And I mean, with that mentioned, that's what also helped me during my primary and high school days to basically push a lot in the commercial subjects in order to ensure that I do make it within the investment management field once I get to tertiary.
So you studied a BCom in investment management at UP. How did that academic foundation shape how you think about money today?
No, look, firstly, it's something that I really enjoyed. And to be honest with you, the extent of the information and the curriculum that I learned from the investment of University of Pretoria, it's really, it really changed my mindset and basically the way that I would see money, because I mean, it started all the way from foundation stage to advanced stage, learning from, and then basically also knowing and learning about all the different financial instruments, what's basically looked at, portfolio management as a whole. So, I mean, it really opened up my eyes, and the way that I had seen investment management as a child, I would have thought that, okay, no, this is easy. You just click one button and make a lot of money. But honestly speaking, there's a lot more to it, and it really opened up my eyes in that manner.
So looking back, what do you wish you had understood earlier? Maybe something the textbook didn't teach you.
That investments is not more about money and being in the market. It's more about human behavior and our emotions, how it goes, that once you have your money laying there on the table, that you need to control your emotions. As much as you might have the numbers working on your side, you really need to understand your own emotions as an investor yourself, that look, it's never a straight line. There's always fear and greed in the markets. There's always everything that will determine the way that you act in terms of panic and also overexcitement when things are going well, because we need to come to realize that they don't always go in a straight line. There will always be peaks and troughs. So, I mean, I think it was more of a psychological, emotional learning and understanding over and above just learning about numbers and knowing what financial instruments are they.
So after your postgrad studies and your RE5 certification, you pursued the CFP designation. What motivated you to take that leap?
So, I mean, being in the industry and beginning, I did not think that I would actually pursue it the way that I actually ended up doing. But then, I mean, being in the industry, you end up seeing how much regulation there is in this industry. And I mean, over and above that, it just no longer became a thing of I'm just doing my job, taking a paycheck home. It was a matter of actually I need to understand what advice I'm giving to my clients in order to make sure that I'm giving the best suitable options to them. And also, I mean, it's a matter of professionalism, and professionalism goes hand in hand with ethics, and yeah, it goes hand in hand with ethics. So, I mean, I felt like, you know, if I'm going to do something, I need to give it my all. So that's why I pushed all the way to the CFP designation, because I felt like that aligned with me in terms of the type of advice I'd like to provide with my clients, to my clients rather.
Yeah. So when you were pursuing your CFP, how was the exams? I know you guys write board exams, ne?
Yeah, it was quite hectic. And I mean, doing it at the same time while working. It was a real commitment. It was really a real commitment. I mean, doing it while working and also having children in the house and all of that. It was a matter of now just restructuring your day in order to squeeze in the academic side and your actual work. So I will not say it was easy, but it was challenging. But I mean, it was worth it because even after doing it, I could tell how my advice philosophy had changed in totality.
So how long does it take to get the designation?
All right, so it really depends on you because with it also changed from the time I wrote it. So, but I mean, in my time, I think they would give you 6 to 12 months. So let's just put it at a year, but it would depend on you in terms of how you prepare and how ready you are. Because there's certain people who actually just register today and then within 3 months they write it because you choose a date that you'd like to write it on. But I mean, at least 3 months of prep before then, because it is really an extensive exam. And I mean, it's not just like your other academic qualifications where it's just memo based. That is either you have what's on the memo or not. It actually tests how you think and how you apply the knowledge, and as well as professional conduct.
So some people see the designation as just a title. Eh? How would you explain the real value to someone choosing to be a financial planner?
Look, I would say that the designation would be the bare minimum that you should be aiming for, as much as it is the top designation in financial planning. But I mean, it should be
Yeah.
the bare minimum you're working towards, because I mean, just the level and in depth of the scope that you go into, because the postgraduate is not easy at all on its own. So the CFP even goes even deeper than that. But I mean, if I'm going to speak about it from my own perspective, it's just the value that it has added towards my advice that it has elevated it. And also basically made me sure about what I'm talking about. Because I mean, at the end of the day, we're dealing with people's lives here. It's not something we can thumb
Yeah.
suck and basically come up with figures and just put them up on the table to just have a sale. Because that's another problem that I tend to have with a lot of people in the industry, that they think it's just sales based, but it should not be sales based. It's all about what value are you adding, because there needs to be a value add into what you're advising people to take on in their personal lives.
Okay. So tell me, what made you pursue the RE5 certification?
So the RE5 is the bare minimum. So for anyone who'd like to provide advice, you need to have an RE5 to just have your foot in the
Okay.
door legally. So, but I mean, you don't need to have it before you get into industry. You can get into the industry, but they give a certain number. They give you a period that it has to be completed before.
Wow.
And then you also need to get signing off. So meaning that you have to have some sort of a mentor. We call them key persons, that for the first few deals or for the first 2 years, depending on the category of advice that you're giving, they will tell you that, okay, you need to actually have the key person basically sign off your advice to ensure that you're not misleading. Or also just, I would look at it as more of a mentorship than regulation, because now it also will build your own confidence to be sure that you're doing the right thing.
So you've worked across different financial institutions, ne? What were the biggest lessons from serving different types of clients across those institutions?
So for me personally, is that every client matters. No
Yeah.
matter what life stage you are in, we need to give you the same level of advice and care in order to help you reach your goals and aspirations. So as much as it can be segmented and fragmented, each and every single person, we need to give the same level of care, because at the end of the day, we're all working towards something. We're all working towards growing something in the long run.
So were there common mistakes you kept seeing people make regardless of income bracket?
No, that's definite. I mean, it's indifferent from someone who just started a retirement portfolio that's worth 10,000 rand to someone who's got 10 million rand. So, but I mean, yes, it's always trial and error. But then, I mean, there are those that are also like you who build up their retirement portfolios without having an advisor. But then, I mean, once they actually sit with an advisor, they tend to go back and look at it to say that no, actually, I could have even worked even more if I had this type of information from the beginning. So that's why I also find it to be very important that as soon as you start, rather have someone who's basically going to be holding your hand and guiding you during the whole process. Because I mean, we do the actual calculations and all of that, because the common mistake that I pick up, if I can use, especially in essence, when it comes to retirement planning, we always say that my employer gives me so much towards my retirement, and there's the contribution and all of that. But then the question is a calculation actually done from the beginning? So to say that by the time you reach the age of 60, 65, 75, whatever your retirement age would be, that this is the amount that you'd like to earn. Because in most cases, people only do that exercise once they have to jump into retirement, and then you find that there's a huge shortfall and it's too late to catch up.
Oh, okay. So as a wealth manager, what does an average eh, as a wealth manager, what does an average day look like for you?
Each day is really unique. It just has each client is unique. But I mean, at the end of the day, we need to structure our own days. So under normal circumstances, I just go by as soon as I open my laptop, I just need to understand what is going on in the markets. I read about the financial markets both nationally and internationally. From there, basically look at my calendar for the day. So to see how many appointments do I have, where are my appointments, and all of that. Because I mean, as much as we're seeing clients, some we see them at their premises, so we do a bit of traveling, we do it on Teams and all of that. So well, once we've gotten all the appointments out the way, that's when I start looking at doing all the admin, some servicing stuff, because like I mentioned, it's quite diverse. Each and every single day is unique. So, but in essence, it really comprises on making phone calls, speaking to clients, being in front of clients, creating actual plans for clients, show them proposals. If they already have a portfolio, we basically now try to rework the portfolio in the most efficient manner where number one, it can save you. If we can save you money, we do save you money. If you need to increase, you will need to increase, because it's not necessarily about the cheapest option that you take. You need to work on something that actually works for you.
So, what part of your job would you say most people don't understand or underestimate?
It's the actual planning and the actual structuring and restructuring, because sometimes we do come across individuals who say that no, they are diversifying by investing in different service providers, but at the end of the day, it's the same. It's the same type of mindset, it's the same type of market, it's the same type of risk profile that is going in there. So our biggest thing is to really educate the client, so to say that this is the way that you should put things in a much better manner, because it is not just about the return on investment. It's also about the tax consequences. It's about the costing of whatever product that you own, because each of them, they differ. And I mean, on that, by restructuring it that way, sometimes they might just look at it and say that, no, but your cost is high. But then just to find that the other person B did not actually do an estate calculation for you. And then you find that right at the end, you end up paying more into tax. So, I mean, is that type of restructuring, because we need to find a balancing act where we factor in everything. So, I mean, I feel like the actual planning sometimes is underestimated up until we actually come with a real financial plan and put it in front of the individual. And that's where they see where the real value is.
So, can a person come to you with cash, let's say 100K, and say, Talani, can you invest this for me? Or you just educate them about the market and all this stuff?
So no, definitely we do the actual investment for all
Okay.
individuals. So if a person comes with money and all of that, so in terms of compliance, there's certain stuff that we also need to follow in order to ensure that we sticking within the guidelines, like a risk profile questionnaire, so that we understand how your risk tolerance is and your risk capacity is, and then we use that in order to also match you up with the type of funds that would suit more in terms of your risk profile that would have done for you. And then from there would also basically based on the investment term that you want to be invested in, that's what also guides us to say, okay, no, this is the type of fund which would be more suitable for you.
So, you mentioned, so do you manage a person's portfolio or you just educate them only?
So we do both, because as I recommend a product, I want to make sure that we're on the same page and you understand exactly what I'm giving you. So it's a combination of both, that we actually basically educate you and basically show you that, okay, I'm recommending this because of A, B, C, and D. That's where the educational part would come in. But as much as the recommendation comes, I do the actual implementation of putting you in the most relevant.
Okay. So, who would you say is the ideal client for a wealth manager? Or is it less about income and more about the mindset?
So for me, everyone is an ideal client, because I mean, I need to be able to help you from wherever you are. Because I
Yeah.
mean, I cannot say that I only want a person with 10 million rand as my client, because that person, before they had the 10 million rand, they started from somewhere. So we also help you to grow from that somewhere to that 10 million rand, because that is part of our duty. And I mean, in us doing that, we try to show you a realistic picture by doing all the calculations. So to say, if you're gonna come to me tomorrow and say, Talani, this is what I want to have 1 million rand in 5 years. Where do I start? I do the whole calculation and I basically work it backwards to say, okay, in order to reach this goal, this is where we need to start. This is how we need to move. And another thing that's I feel is a mistake a lot of people make. They think they come to a financial advisor once, they get their advice and it's over. And advice is ongoing, because at least once a year we need to come back, have a look at everything, because plans change, dynamics change, you get married, everything changes. There's a new child born, everything changes. So that always has to be readjusted.
So can a person that earns maybe let's say 5,000 come to you as a financial as a wealth manager and ask for assistance?
Yes, no, definitely. I mean, we'd be able to assist them, and I mean, we'd also just have to play within the confinements of the funds that we have available, because I mean, it's starting somewhere. Because I mean, if the person is say 21 years old and says I've got 5,000 rand and all of that. To me, when I see a 21-year-old, I look at it as you still have 45 years to invest to the age of 65, and the longer you have, the bigger the compounding effect of your funds over the years.
So what mindset net tells you someone is ready to build wealth intentionally?
There's no particular mindset, honestly speaking. It's just the willingness, and also the willingness to stay the course, because you might not think that you're ready right now, but then I mean, even if you start with that 500 rand every month, in 10 years down the line, your financial situation could change. You could then start affording 50,000 rands a month and be a bit more aggressive. So that's why I would say that I would not be too picky in terms of that. I would rather be able to serve everyone, because I feel like everyone needs the same level of service.
Okay. So from your experience, what are the three financial habits every South African should master before even thinking about investing?
So with this, if we're gonna put it as three, number one, I would definitely say budgeting. Because
Okay.
once you start with the budgeting process and you're in control of your funds and you're in control of how you're spending, how you're saving, and basically also just keeping in mind what your goals are, you've done most of the job. The other two sides of it is that when we're looking at financial planning and wealth management, there's two aspects to it: is the wealth protection and the wealth creation. The wealth creation side, I mean, let's start with the protection. Sorry, the wealth protection
Okay.
side is more of your risk planning. So to say that if I to become disabled, if I get a critical illness, because that's the reality. I mean, there's a misconception of saying, no, but I'm still young, this stuff are too far from us. If you're actually going to read the stats, they say individuals currently below the age of 35 are the ones who have quite a high rate of your critical illness. Your critical illness, we're talking about your cancer, stroke, heart attack, those things. It's our reality right now. So the question is, if you're going to find yourself in that situation right now, would you be able to survive going forward? So that is where the protection comes in. And by that protection, you're protecting your income, you're protecting your assets for the long run. And then once all of those things are in place, then you start looking at the wealth creation, which is more on the retirement and your investment. If you're saving for buying a house in 5 years' time, if you're saving on buying a property, vehicles, or any particular thing that you'd like to put money away from, that is where the creation comes in.
So the three tips you mentioned is budgeting, wealth creation, and
Wealth
wealth
protection.
protection. Right?
Correct. Yes.
Which one do people struggle with the most?
I'll always start off with a budget. I'll always start off with a budget, and then I'll put next to wealth protection, because we are always on this fast lane of just trying to create wealth instead of just setting the foundation within our process. Before you start creating the wealth, you need to protect what you already have.
So I have a scenario. Let's say someone earns well, but never sees where their money goes. How do you break that cycle for them?
It would still go back to the budgeting and doing the budgeting exercise. And I mean, even if that is the case, if the person already has like your provisions towards a retirement annuity, your provisions towards your risk and all of that, we can always play around with those things to make sure that you've got enough cover at the correct amount that you can actually afford. Because whatever amount that you're paying is not cast in stone. So I mean, that's always the starting point to work around the current policies and investments to say, okay, based on where you are, let's try decreases. But I mean, we can only see that through a budget. So that's why I would say that the starting point would be the budget.
So everything starts with a budget, you know, me.
Definitely.
So let's say someone wants to is your client, né? And maybe they're thinking of buying a car. Should they come to you first and tell you, hey, I want to save up for a car, or they just do it and tell you late?
It's always advisable to first come over, because the problem, if you tell us and then if you do it now and then you let your advisor know later, the problem is it's already too late to turn back, because you could have signed up for your higher interest rate on the vehicle, and also maybe not saving enough for a deposit and all of that. Because as also mentioned earlier, it's that we can also do a calculation to say, okay, no, fine. 5 years down the line, you want to buy a $500,000 car. Or rather, sorry, let me rephrase. You want to buy a $500,000 car right now. And then you go
Yeah.
check installment and all of that probably costs you 12 to 14, 15,000 rands per month, depending on your situation. And then in most cases, if we do the reverse calculation to say, okay, let's assume you want to buy a $500,000 car in 5 years down the line, and we also inflate it. We could be saying that, okay, no, maybe you need to start putting away 9,000 rands per month so that you can buy the car cash later on. So, cash flow wise, that's already like a huge difference. And now you're also using interest in your favor than it working against you through the investment that you were putting the money in.
So I want you to tell me, né, do we classify a car as an asset or a liability?
It really depends on how you go about it. Because I always say there's no right or wrong answer to it, because if you're going to say it's not an asset, but you need it to do your work. So let's say you are a sales rep and you need your
Yeah.
car to get to clients. I would see it as an asset, but it's always dependent on the type of car you buy and your use for it and your affordability and how much that you can actually are willing to pay and how you see it. So I would say that it's always very subjective, but obviously if you're taking higher purchase on it, it is a liability that you're taking on. But then, if you need it for employment, it would still be an asset, because then you'd be basically generating assets from the use of the asset,
Mhm.
generating an income. Yeah, to say, yeah.
So many people misunderstand the difference between saving and investing. How do you explain it in simple terms?
In simple terms, if you talk about savings, it's money that you are putting away that within the next 12 months you could need it at any time, because then you currently, in essence, you basically want your savings rate is going to be more or less in line with inflation. But then investing is more of longer term in nature, where you know that you're going to put away money for at least 3 years. I would put it like that, because 3 years is at least medium term type of investing. And then over there, you're actually looking for capital growth. So meaning that once we see people working on those, then we're actually going to look more at looking at growth assets. And your growth assets, we're talking about your shares, your having exposure to the share market, property market, bonds, and money market. But that's where that's more where it comes over to the type of fund that we would suggest that you go into based on those type of goals.
So would you suggest that the person start off with an emergency fund first before they start investing?
Most definitely, because you really do not want to disturb your investment plans because of due to lack of funds or due to emergencies happening. So we always say that, look, if you can have at least 3 to 12 months, but depending on your needs, with of an emergency fund, because the longer the period, the more of a safety net you've built for yourself. And so that if there's any shocks and all of that, you're also not diverting from your long-term goals within your investment. So definitely an emergency fund is an absolute necessity for everyone.
So how much should a person have in their emergency fund?
So I always say that work on the amount that you need per month. Because if my salary, I'm earning 20,000 rands net per month. If I say I
Yeah.
want it over 3 months, it would be 60,000. If my salary is 20,000 rands per month and I want it over 6 months, it would be 120,000. So I would say work on it that way. So to say that should you lose your job now, it gives you that bit of time to actually look for other employment while you actually have 3 months or 6 months worth of your salary.
So I can't just use the money, Jay. If maybe let's say I want to buy like a pair of sneakers for no reason, or I can still tell it.
With proper reason, yes, you can, because things happen. Hey, things happen. You get a tire puncture, windscreen gets hit, you know, TV breaks, anything can happen. So that's the whole purpose of emergency fund. But ideally is to just have a multiple of your salary in it when building it up.
Uh,
But But your pair of sneakers, those are more of wants. But for needs, most definitely, you can dip into it.
Okay. So, before investing, you spoke about risk planning. Why is risk cover part of becoming an intelligent investor?
It touches again back on the wealth protection that we spoke about, because anything can happen between now and our retirement age and even after our retirement age. So I'd like to just give an example of critical illness, for example. It's that critical illness, heart attack, cancer, stroke. As mentioned, it can happen to anyone. But now, if you now get diagnosed with a cancer and you cannot go back to work, your employer usually only pays you for a certain period, and then from there, they can't do anything for you. But I mean, if you have those provisions in place, we can always plan around it, whether it be disability, whether it be income protection, to ensure that your life goes on comfortably. And again, I'm talking about before retirement. Even after retirement, that is where now you even need your critical illness even more, because you had a higher probability of those sicknesses that I mentioned. So that whatever you've put away towards your retirement, it doesn't get affected by those sicknesses happening, because you would already have it covered.
Okay. Uh, so in your view, what defines an intelligent so in your view,
Practically, look, we need to be holistic about everything. And taking a holistic view is looking at your risk planning to say, what if something happens before I actually reach my goal? The other question is, what if nothing happens before I reach my goal? Because there is the reality of things. So we need to be able to cover ourselves on those aspects, that what if something happens? That's your risk planning. What if something doesn't happen and I grow old with it? That's where your investments come in. So, I mean, having to look at it that way, it's definitely an intelligent invest. It's looking at things holistically as an intelligent investor, as you would put it. And secondly, also realistic goals. Let's have realistic goals. Don't put away R1 million today and then say tomorrow you're expecting to have R2 million. Because as they say, is that if it sounds too good to be true, chances are it is.
But okay, how long does it take for a person to make a million?
Again, it depends on your goal. I mean, if you tell me now that I want R1 million in a year, just
Yeah,
breaking down simple maths, we're talking about you putting away 80,000 rands a month
for 12 months.
over 12 months, because 80 times 12, 960. So, I mean, plus growth would probably be in a million that way. But then, I mean, breaking it down again, if you say, no, I want R1 million in 10 years, then that 80,000 decreases substantially, because now we're going to be using compounding interest in order to grow towards that goal. Like I say, you begin somewhere. Like, I mean, you can be where you are right now and say that I want so much. And then we basically work with it going up so that we can help you build that wealth. So that's why even initially I did mention that we don't really say that, no, we only want wealthy people. We want you from where you are to help you build that wealth. And then we grow with you.
That's awesome. So, what do most first-time investors get wrong about investing?
Looking for miracles in the market. That's the first thing I'll go for. Looking for miracles in the market to say, if I put in so much.
So, what do most first-time investors get wrong about investing?
So in most cases, first-time investors, I mean, it's always hoping for miracles. And I mean, that's just something I come across, hey, where individuals will come through and expecting to make a quick buck, but not actually realizing that investment is a slow and steady game. I mean, it's what has always been said, that it's not about timing the market, it's about your time in the market. That's where you're going to create real growth and real wealth over time. So in short, it's basically people just looking for rather quick returns on their investments.
So, what's one truth that you wish every young investor understood?
So the one thing that I wish that every young investor understood, it's basically start from where you are. And I know that I'm sounding like a broken record with that,
Yeah.
but that is the reality of it. Because when we see the big figure, let's say R1 million, you're thinking that, oh no, when will I get there and whatnot? But if you just keep your head down and stick to the basics, put your money where you're supposed to be putting it, and let it be invested and let it compound over time, that's what really works.
So, can a person invest with just a 50 rand nyana or a 100?
Yes, definitely you can, but then also don't expect to have R10 million in 5 years by doing so. But you definitely can.
So, you specializing in investment selection and wealth management. When building a portfolio, what factors matters most? Is it income, goals, risk tolerance, or time horizon?
Okay, so in my particular instance, I don't actually do actual investment selections. It is more on working on different portfolios that have fund managers at the back who have done the investment selections, but each portfolio has got its own fund mandate. So based on that, what happens is we do a risk profile questionnaire, which comes and talks to your risk tolerance, as you've just asked me right now. So the biggest thing is we basically interview the client and basically understand what their income is, what their goals are, what their time horizon is. And then through the risk profile questionnaire, we get the risk tolerance. And then by putting all those things together, we come back with a solution for you. Because the reason why we have to also do it that way is to also manage expectations. So to know that, I mean, if you want to invest for 1 year, for example, I cannot put you in a fund that's heavily exposed into shares, and vice versa. Even if you're cautious and you want to invest for 20 years, putting your money in cash is the same as just putting it under your bed, because inflation will very quickly erode it. So all those factors is what we actually factor into it when we actually providing the advice in terms of how you can put your money away. And basically, it's not necessarily just how you can put your money away, it's basically how you can achieve your goals.
So, what does risk profiling insist of? Is it only about asking the client questions on?
So there's a questionnaire that we provide a client with, and then based on how they answer that question
Okay.
is what determines the risk profile that we profile you on. And I mean, the type of questions, it's like, how would you feel if the market was to drop by 20%? Would you pull your money out of the market? Would you hang in there, or how would you act? You know, so would you require any withdrawal from it, from your funds within a certain period? So it's basically to just profile you in essence to ensure that we're putting you in the right type of portfolio.
Oh, okay. Now I understand. So, emotional investing is a big issue. Reacting to fear, hype, or social media trends. How can someone protect themselves from emotional decisions?
So, I mean, from that, it's about sticking the course, hey?
Ah,
I mean, if you've told yourself that you want to have 10% of a bond that you want to put out, that you'd like to achieve in 5 years' time, 3 years' time, and whatnot, irregardless of how the markets move, markets always correct. So, I mean, the media, it's gonna be there because I mean, so sometimes the media they also need to sell. So I mean, fear is an easy emotion to tap into to any other to any human being in general. And social media trends, I mean, a few years ago, we saw there was a huge influx of Forex traders, but now all of a sudden they've disappeared. You might ask your question why, but that's not the topic for today. But so, because I mean, it's basically going in on the fear and the hype and I mean social media and having everyone being exposed to social media so much, it's so prevalent in this day and age that we're living in. So I mean, in order to cut out fear is to stick to your goal, stick to what you want to achieve. And basically, as part of that, maybe going back to the risk profile questionnaire, it's also a tool basically to for managing emotions once you're in there, because based on your profile, we put you in the respective portfolio so that to avoid such things that even if your portfolio is to dip by 5%, you know that you say that no, you're willing to take a dip of up to 15% and of which that is managed from the onset.
okay, how much dip can a person take, man?
That depends from individual to individual, and it depends from individual to individual, and it also depends on how long you're investing and how aggressive you're investing, because I mean we can't compare a dip of an offshore fund
Yeah.
to a dip to a dip in money in a money market, for example, because there's I don't want to say there's no dips, because there are certain cash funds that do have dips, but then certain funds don't have any dips at all when it comes to money markets and cash funds. But then, I mean, that really depends on the fund and the fund mandate. But then all those details, we usually have them before we actually place you there, because we have to read thoroughly to understand that, oh, okay, this is something that is in line with what you're trying to achieve.
Okay, so I want us to talk a little bit about practical steps. If someone earns maybe 15K or 30 or 60K a month, how should each of them start investing intelligently?
There is no right or wrong answer to that. It just goes back to your goal and what you are able to take in and contribute towards. So there is no definitive answer, because I mean I can find 20 people all earning 15,000 rand per month. I can invest them differently individually based on what they're looking for, based on their risk profile, based on what they're trying to achieve.
Oh, okay. Let's say we're talking about a 25-year-old earns maybe 25,000, and
Mhm.
maybe when they retire, they want to retire maybe with, let's say, 10 million. So how would
Sure.
Yeah, how would you advise them? Which product
So
to
with
go
that,
for?
so we don't just go into product. We do comprehensive plans. So on that, I mean, there's different products out there. There's tax-free investments, there's retirement annuities, and not to also get into other products as much because then it would depend on what type of investments the person already has that determines the type of product we can put you in. But then let's just say the person is trying to reach the goal of 10 million rand. We can look at both aspects of both using the tax-free and the retirement annuity because of their tax benefit while they're compounding over the years. So, but with that as well, even if their salary is at that amount, it goes back to will the salary be able to afford the premium that we not the premium per se, the contribution rather that they need to contribute in order to reach the 10 million because we can only tell you about the contribution only after we've done the calculation.
So I heard you say something about tax-free investments. Can you like maybe explain to us what are the
So a tax-free investment is a product that our country basically got exposed to a few years ago. If I'm not mistaken, could be it got introduced plus minus 10 years ago, but I stand to be corrected.
yeah.
So on the tax-free investment, it's on the premise of to motivate South Africans to invest. Because then, in that way, when you're investing in a tax-free, it's exactly as the name insinuates. The returns are free of tax. So,
Okay.
but then it also comes with its own rules around it to say currently in one particular tax year, you can't contribute more than 36,000 Rand, which basically equates to 3,000 Rands per month in a particular tax year. And it's a lifetime limit contribution of 500,000 Rand. So put in simple terms is that a tax year is 1 March to 28 February of every year. During that period, if you contribute less than 36,000 Rand, everything that you make within that fund, whether it's invested offshore, onshore type of funds, or aggressively into shares type of portfolios and things like that, there will not be any tax implications because under normal circumstances there would be capital gains tax, there would be interest tax, dividends tax, and all of that. So meaning that on a tax-free, none of those actually apply. It's only once you contribute more than the approved limit of 36,000 Rand per tax year that the amount above the 36,000 will be subject to tax.
Okay. So I want to know, is a tax-free savings account a savings account or an investment account?
So it really goes from the provider that you select. But I always say that, well, I always prefer the tax-free investment because then at the end of the day, you're looking for growth. Like the question
Yeah.
that you asked me earlier about the savings versus investing. It's all about the growth because you want growth. If it's in a savings account, I mean, if you put a tax-free in a savings account that's earning interest, yes, it's nice to preserve the funds, but then you really need to grow them. So I would prefer going investment route.
So I can treat it as a retirement fund.
So we always say that rather use it as a supplement to your retirement fund
Okay.
because of its limitations that are there. And remembering that also if you've got a retirement fund, the contributions you make towards retirement funds, you get a tax deduction at the end of the tax year from SARS for contributing towards your retirement. So I always say that use them together, hand in hand, because once you reach retirement age, retirement funds have their specific set of rules. A tax-free investment, you can use the money however, but then you can also just use it as an emergency fund because in that point in time, an emergency fund can be used for medical bills and any unexpected expenses that you may have at that point in time, instead of having to stress out all your retirement funds at that point in time.
So do you think every South African is able to maybe like invest for retirement?
Most definitely. Actually, each and every single South African should be investing for retirement. And it's never too late. I mean, I would rather have X amount than zero. For me, that's a no-brainer. So I would definitely say each and every single. And I mean, going back to what I just mentioned also about the tax benefits, because the tax-free investment has got tax benefits to it, and so does a retirement annuity. But it all depends on how the planning goes around it. And that's how we assist our clients.
So that means if a person maybe earns 4,500, they can still save for retirement.
Most definitely. I mean, with that 4,500, even if they're contributing 250 per
Yeah.
month, you are still growing an investment. You're still taking advantage of compounding. You're gonna still have something at the end of the line. Should you stay diligent along from now up until you reach your retirement age.
Okay. So
And
let's
the
say
250, by the way, is just an example. So
uh,
don't take my word for it.
okay. So for someone who feels overwhelmed by money, where should they genuinely start?
Again, I always just say start from the beginning, start from where you are, and then build from there. Because then once you've started, you've got that conscious your conscious mind basically tells you that this is something I've committed to. This is something that I'm basically I'm moving with. So that even every little penny that you get extra, say from your bonus, from a side business or anything, you can always just throw it into your investment. And that way it will just grow because I mean you have to be in it in order to earn from it and benefit from it.
Okay. So with the rise of financial content on social media, many young people are learning from TikTok, Instagram, Twitter instead of professionals. How should the youth balance online financial advice with real world claims?
So they definitely need to sort advice from a professional because it's not just advice, it's planning. The reason why I'm stressing it out that way is because what comes into planning, it goes back to another point that I mentioned earlier. It's basically where you are in your life stage. So where you are in your life stage, your planning is going to differ. And as you move on to the next life stage, as you grow older in essence, your planning also changes. So that's why it's always an ongoing process that needs to be followed and monitored on a yearly basis. So, I mean, a lot of social media gurus in inverted commas, that I can put it like that, most of them, I don't want to say all of them because it's not all of them, but most of them, they're not even registered with the FSCA. They don't even have the RE5 that actually allows them to provide advice legally.
Yeah.
So, meaning that there wouldn't be much recourse other than going to a professional. What I put down on paper for you, I have to stand behind it to make sure that that is the best thing that I have to put on the table because I'm licensed to do so, and my license obliges me to do so.
What's one red flag you'd advise the youth to watch for when consuming financial advice online?
The red flag would be always just research about the person allegedly providing advice online. Check if they're accredited to provide that advice online. Because then the red flag that you're going to see is that if you do research on the individual and they don't have the required accreditations, be worried. It's like going to a doctor and you find that they don't even have or going to a lawyer and realize they don't even have an LLB. You should an attorney rather, an admitted, a supposedly admitted attorney without an LLB at a bare minimum.
So you've been in the industry for almost a decade. What keeps you motivated?
For me, the one biggest thing that keeps me motivated is knowing that I've made a difference in someone's life that I've sat in front of. I have passed on information. I have passed on education that's gonna help them reach their goals. That's gonna help them be better off than where they were. That is really the biggest thing for me. That each and every single person that I sit in front of, I want to make sure that I've done the right thing for them.
So what's the one legacy you want to leave through your work?
I think it would still go back to the answer
Okay.
that I just gave to make sure that I've added value, to make sure that I've added value, because that is the biggest thing for me, to add value.
Is there something else maybe you wanted to talk about?
Nothing top of mind, really, hey?
Yeah, so
Really nothing top of mind, but yeah, it's just, yeah, in essence, financial planning is for everyone, and the sooner you start, I mean, we also see it with individuals that happen to start at a very young age and then now they are old. You can tell by opening that person's portfolio that they started from way back and they didn't just start in their 40s and all of that, and it also relieves pressure and stress once they reach the retirement age. That is the one thing that I feel is very important, because just the stress levels of not being able to retire, the an individual can end up in the grave, unfortunately, due to that. So it just goes back to that financial literacy is very important, and it's something that we should all take seriously.
So a person can still start investing maybe in their 40s and still achieve their goals.
They definitely can, but we just need to also make the individual aware that you need to be aggressive, because now we don't have as much time as a 25-year-old. A 25-year-old, to reach the same goal as you, could probably start at 2,000 rands per month, while you probably have to start at, say, I'm thumb sucking a number, 6,000, 5,000 rands per month, if not 8, if not 10, because then the younger person, they've got the advantage of time and compounding interest. I mean, it's 40 years versus 20 years of compounding. That makes a world of a difference.
Okay. So with that being said, Talani, thank you for sharing your journey and your wisdom with that being said, I don't know, maybe you have any closing remarks that you want to share?
No, no, all good on my side. And thank you for having me.